So last weekend, we had a family barbecue. And the barbecue ended up costing us 20% more thanks to all the kerfuffle with these new tariffs. So if grocery bills are going up about 20% roughly, at least, what do you think's happening with your investments? And no, they're probably not all going up. I, like many people, have had my investments take somewhat of a hit due to all these tariffs. So it got me to thinking, I wonder if there's a way that you can somehow tariff-proof your investment portfolio, or at least make it less susceptible to tariffs. Turns out there is a way. You can at least reduce the impact because tariffs affect everything, right? Here it is, a quick summary, the Cliff Notes version of what you can do to minimize the impact of tariffs on your investment portfolio and its exposure to tariffs, practical everyday steps. Number 1, spread your money worldwide. Don't keep all your investments, your ETFs, your index funds, your stock investments, all just in one country. Do this by buying stocks, ETFs, index funds in various countries, such as Europe, Asia, and those that don't rely on cross-border trade between, say, Canada and America. Start by picking a global equity ETF. This helps diversify your portfolio and spread your investments more worldwide. Reduce reliance on North American markets by investing in international equities, particularly those less affected by these ongoing trade tensions. Market volatility. The S&P dropped 15% after the tariff announcement, indicating just how sensitive the market is to trade policies. Your investment portfolio that is heavily reliant on cross-border trade is suddenly facing significant risks. 2, focus on domestic-orientated companies. Invest in companies with minimal exposure to international trade. For example, this could be regional banks or utility companies, as they have more stable domestic operations. So I'll give you an example of this. Jason, a normal middle-class Canadian investor, is worried about the ongoing trade tensions, such as supply chain issues, geopolitical factors, and tariffs. In short, what we're all going through right now. And he doesn't want his investment portfolio to experience these wild swings every month. So what does he do? He focuses on Canadian-operated companies that aren't heavily impacted by global international trade. So why this helps? Even if there's a global trade war or an international market crash, these companies are less exposed. Their domestic focus means that they generate revenue primarily from within Canada. This gives Jason stability and peace of mind, so he can sleep better at night, and he's not in a panic with his investment portfolio experiencing wild swings every month.
All right, let's just stay calm here. Don't get all crazy on me.
He chooses utilities like Fortis Incorporated, FTS, or EMRA, EMA. These provide electricity and gas to Canadian homes. Their revenue comes from regulated local operations. Regional banks, like Canadian Western Bank, CWB, focuses mainly on Western Canada, serving businesses and individuals in the region. To simplify, Jason buys ETFs that bundle these kind of companies. BMO Equal Weight Utilities Index ETF, ZUT, iShares S&P/TSX Capped Financials Index ETF, XFN. I hope I haven't lost you with all these acronyms. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst, living in Western Canada. I talk about personal finance, investing, and investment portfolios. I've been investing for 2 decades now, and I think it's safe to say I know my stuff. If this all sounds like something you'd be interested in, consider subscribing to my channel. 3, incorporate inflation hedges. Okay, what does this mean? Inflationary pressures. Tariffs increase the price of consumer goods, leading to inflation and potential interest rate hikes. Tariffs make everyday items simply cost more. Think about adding gold or real estate to your investment portfolio, because when prices rise, these items keep pace better than ordinary stocks. Assets like gold and real estate hedge against inflation. For example, SPDR Gold Shares, which is a popular ETF that tracks gold prices. Gold will increase gradually over time, but isn't prone to the wild fluctuations and is less volatile than stocks or even bonds in the market. Number 4, utilize currency hedging. Translation: currency exchange rates and the fluctuations can severely impact returns. Consider currency hedged ETFs or funds to help mitigate this risk. For example, Sarah is a Canadian investor who wants to invest in US tech companies like Apple, Microsoft, and Nvidia. She's worried that if the Canadian dollar strengthens, her US investments held in USD could lose value when converted back to CAD, even if the US stock performs well. What she does? Instead of buying a US listed ETF like QQQ, which tracks the NASDAQ 100 in USD, Sarah chooses a currency hedged Canadian ETF like BMO NASDAQ 100 hedged to Canadian ETF ZQQ, or iShares S&P 500 CAD hedged ETF XSP. These ETF invest in the same US stocks but use currency hedging to neutralize the impact of CAD USD exchange rate changes. Why this helps? If the Canadian dollar rises, which would normally hurt unhedged US investments, Sarah is protected. The hedge offsets the loss. If you buy US stocks, a stronger Canadian dollar could eat into your gains. Currency hedged ETFs automatically take into account currency fluctuations, so it's not a win-lose based on the exchange rate. It's based on that company's performance. She can focus on the performance of stocks and not all of the currency noise. So in summary, currency hedged ETFs like ZQQ or XSP allow Canadians to invest globally without worrying about exchange rate swings eating into their returns. Hey, do me a favor. If you feel like you're getting something out of this video, would you hit the like button and leave me a comment below saying what you think the best investment portfolio is, or with whatever you want to talk about, even if it's just to say hi. Number 5, invest into high quality bonds. Government and high-grade corporate bonds provide stability during economic downturns. They perform well when equities are volatile. So implementing this strategy, assess your current portfolio. Identify sectors and assets heavily exposed to international trade. Rebalance asset allocation. Readjust your investment portfolio to include domestic equities, international stocks, bonds, and alternative assets. Monitor economic indicators. Try your best to stay up to date on currency movements, international trade policies, and inflation. Trade tensions between Canada and the US can pose significant risks to our investment portfolios. By diversifying internationally, focusing on domestic-oriented companies also, I understand that's kind of contradictory, diversify internationally yet focus domestically, stay with me on this. Incorporating inflation hedges, focusing on currency strategies, and investing in high-quality bonds, all of this can better help protect your investments. If you enjoyed this video and you're curious about how you can construct the best possible portfolio based on your age, check out this next video here.